Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome, and I'm delighted that you are joining us for the launch of our new podcast, Real Estate Investing Abundance. 3 times each week, we will bring value bombs of investment wisdom from the most successful and renowned experts in the industry. The focus is on passive investment in real estate to help you as our listeners develop financial independence to live life abundantly. If you enjoy the show, please take a moment, find us on Apple Podcasts, and leave us a review. Reviews are vital to growing our audience so we can help more people find their avenue to financial freedom. Each week for the first 4 weeks, we will do a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. So please go to Apple Podcast and leave us a review. Hello, enlightened investors. Happy to be back with you again today. I'm your host, Dr. Allen. Would you like to invest in passive real estate opportunities but are afraid of losing your hard-earned money in a bad deal? Today's expert guest authored a best-selling book to prevent that very thing from happening to anyone else after seeing a friend of his lose everything in a deal that went very bad. As a busy professional, passionate about the work of your calling, you may have come to realize that the hope of developing financial independence has taken a backseat to the priorities of following your passion. If you can identify with this, as I certainly can, I have great news. Steed Talker Capital is an investment company designed for passionate, fulfilled professionals like you and me to help us develop passive streams of income built on solid real estate investments. Go to our website, steedtalker.com, and enroll in the Enlightened Investor Circle. There you'll receive education and support for your passive real estate investing goals, no matter your level of investment experience or expertise. Brian Burke, our guest today, has acquired over $500 million worth of real estate over a 30-year career, including over 3,000 multifamily units and more than 700 single-family homes, with the assistance of proprietary software that he wrote himself. Brian has subdivided land, built homes, and constructed self-storage, but he prefers to reposition existing multifamily properties. Brian is the author of The Hands-Off Investor, an Investor's Guide to Investing in Passive Real Estate Syndication. Brian, before we delve into passive real estate investing, briefly take us back to those humble, formative years to give us just a foundation as to where you came from to get to where you are today.
And I appreciate the great introduction. I hope I can live up to it all. And I started out in this business where an introduction such as that would have sounded entirely foreign to where I was when I first started in this business, because I had no knowledge about real estate investing. I had none of my own money. I didn't have any connections in the industry. And I had just a big dream that I could make it one day. And I just put one foot in front of the other and kept going and made my first real estate investment before I even owned my own home on buying a small little rental property. And then my career grew from that first property over 32 years ago to over almost 750 more properties that have come since then, starting out in single family and then working my way up into multifamily. I've done mostly multifamily over the last 10 years and have been doing it at least to some extent over the last 20 years. So it's been a long road to get here, Alan. And I figured now that I had enough experience in this industry, it was finally time to write that book people have been telling me for about a decade I should write. And here it is.
And an excellent book it is. Viewers and listeners, you do need to get a copy. It is one of the best books I have read for a passive investor in real estate, and Brian covers everything. If you are interested in passive real estate investing, that's a book you need to have in your library. And we're going to talk about that book today. And Brian, let's just start off with what a passive investor really needs to know and understand. And I think the first thing they really need to know and understand is what is equity, because they are going to hear that term time and again as a passive investor. So what is equity?
Equity really is just, in the simplest term, money. That's equity means people are familiar with equity in their home ownership world, right? Where you say, oh, my house is worth $1 million and I have a loan on it for $750,000. So I have $250,000 in equity. That's the way most people think of equity. But in the real estate private equity space, the word equity really translates to the money that is brought to a deal that's not debt. So in other words, we're going to buy an apartment building for $10 million. We're going to get $7 million of debt from a bank, and we have to bring $3 million to the deal to get the deal closed. That $3 million is generally cash that's raised from investors, the passive investors, and it's that cash that's called equity.
What is capital stack?
Capital stack is just a generic term that describes the entire capital going into a deal. So if you, in that example deal I just gave, we had $7 million in debt and we had $3 million in equity. That comprises $10 million for the purchase price of this piece of real estate. The capital stack is just referring to both of those components. So it really means the total capital. And you'll hear this term thrown around like in a lot of weird ways. They might say, yeah, the capital stack looks like this. There's 50% debt, 10% preferred equity, and 40% common equity. Or it might be there's different classes of shares. So they might say there's 70% debt, 20% Class B shares, and 10% Class C shares. There's just a bunch of different ways of describing it, but a capital stack really is just referring to all of the capital required to make the transaction happen.
So that's both debt and equity and everything that goes into purchasing of the property. So capital stack would include reserves, it would include deposits, it's going to include the attorney fees, due diligence fees, all the fees that go into that. So it's absolutely everything.
It's absolutely everything. What you're referring to a lot of what you're mentioning there is just the sources and uses of funds, right? You get the money from somewhere and you spend it somewhere, and that's your sources and uses. So your sources of capital is the quote unquote capital stack. Equity, debt, preferred, mezzanine, whatever different kind of financing is brought in. It's the sources of capital that comprises the capital stack. The uses is where do you put all of that money? Some of that money will go towards the purchase price. Some of that will go towards closing costs. Some of that will go towards financing fees. Some of that will go to sponsor fees. And that uses of funds will vary from deal to deal.
Let's talk about the entities that are going to be involved from a passive investor's perspective. There's a number of different entities, but by and large, a passive investor is probably going to be interested in the limited partnership and the syndication. So tell us a little bit about what those two entities are and how equity and capital stack is going to relate to those two entities in that purchase process.
Yeah, when you're in a passive investment, you're investing your money with an active participant. Let's say you're a passive investor and I'm a syndication sponsor where I'm acquiring a parcel of real estate and you're bringing capital into the deal. So I can't buy the real estate in my own name and just borrow money from you. I could on this kind of a scale. It's just not how it's done. Where generally money is raised from a number of investors. It's pooled all together. So the property doesn't go in a person's name. Instead, what you do is the sponsor of the investment will create a legal entity. That legal entity will hold title to the real estate. And there may be a series of legal entities that are created in these transactions. Sometimes the organizational charts can get enormously complex, but to keep it in the simplest of terms. So let's say that I form an entity. In that entity, I buy the property, and then you as an investor, you invest your money into that entity. And so that entity could be a corporation, it could be a limited partnership, it could be a limited liability company, also known as an LLC. In the majority of cases, you'll see that these legal entities are structured as an LLC, a limited liability company. Now, in some states, you might see a limited partnership structure used. It's somewhat common in California, for example, which has exorbitantly high fees for LLCs. And so oftentimes limited partnerships are used instead. But essentially, this is just a legal corporate entity that has an operating agreement that specifies what the relationship is between the investment sponsor and the investors place their money into that legal entity. The legal entity buys the real estate, and the legal entity is controlled by the active sponsor that set the deal up.
We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestra also enables other real estate entrepreneurs and syndicators to build and use Avestra's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestrainc.com. Avestra, real estate investing made simple.
There's three documents that passive investors is going to want to be familiar with and to learn about and to understand. And those are the private placement memorandums, the operating agreement, and the subscription agreement. So just give us a rundown on what all three of those are and what is the importance to the passive investor to all three of those documents.
Yeah, the most important one in my view is the operating agreement. The operating agreement is the legal agreement that governs the entity that was formed, and it specifies exactly the roles and duties of the active investor and the passive investors. It also specifies what the profit splits are and what the cash flow distributions are and how those are made. So the operating agreement is the controlling governing document. It's extremely important that investors understand the terms contained in the operating agreement. The next one is the PPM, it's called. It's the private placement memorandum. And what that document is, it's designed as a disclosure document. It's basically a very lengthy document that is designed to tell you how crazy you are for even considering investing in this deal. It's going to disclose every conceivable risk. It's like the tag on your hairdryer that says, don't drop it in the sink. If they can conceive of a possible thing that could be a risk to you, then it should be contained in that private placement memorandum. Also in that PPM is going to be a summary of terms of the operating agreement. And basically what that section is, it's just a section that describes the basic overview of what the operating agreement is saying. It's condensing what might be a 30-page operating agreement down to 1 or 2 pages of the important highlights. How are the profits to be distributed? What is the percentage? And so forth, those kind of very basic high-level terms. And then it generally will also have as an exhibit the operating agreement, so you'll have easy reference to it, and it might have other exhibits attached to it as well for you to review. And then finally, the third important document is the subscription agreement. The subscription agreement is the actual document that you sign to become a part of this investment. And you could think of it like an order sheet for a stock, for example, or you could think of it as just, it is what it is. It's an agreement to subscribe. You're saying, I want to subscribe to this investment, but in order to do, I've got to agree that I'm going to be bound to the terms of the operating agreement. I'm going to agree that I understand that my interest can only be sold under certain conditions to third parties and so forth. And once you sign the subscription agreement, next thing usually happens is you wire your funds and now you're in.
So the subscription agreement is the contractual agreement. Is that correct? Or
it's the contractual agreement with you to subscribe to the investment. So it doesn't govern the terms of the investment. The operating agreement does that. What the subscription agreement does is it's you agreeing to be bound by the terms in the operating agreement.
Okay. So does the passive investor also sign the operating agreement, or is the only signing actually done in that subscription agreement?
Generally, it's only in the subscription agreement. No need to sign the operating agreement in most cases if the subscription agreement is referencing to the operating agreement, and by virtue of signing the subscription agreement, you're agreeing to be bound by the terms of the operating agreement. There'd be no need to sign the operating agreement itself. Now, having said that, remember that every set of documents in a passive investment is drafted by a lawyer. Every syndication sponsor that's offering securities to the public or to their inner circle or however they're marketing these securities or not marketing it as the case may be, is done by a different counsel. They'll have their own attorneys, and each of these lawyers will have their own opinions on their comfort level with a variety of factors. And one of those is signing the operating agreement. Some lawyers like to see the investors sign the operating agreement. Others understand that the subscription agreement is binding them to the terms of the operating agreement. Therefore, no operating agreement signature is necessary. So just because I say that they don't have to sign the operating agreement if they sign the subscription agreement doesn't mean that the counsel that drafted the set of offering documents for the investment they're looking at wouldn't rather see that happen and has placed a signature box for them to do so and asked them to do so.
We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn.
Well, what are the key things that a passive investor should be looking for in these three documents?
You're looking for the gotchas. And generally, a lot of the stuff you should already know before you even see an operating agreement, a subscription agreement, or a PPM. If a sponsor has approached you with an investment opportunity to say, here's a passive investment, we're going to buy this apartment building, here's what the numbers look like, and that sort of thing, you should already know just by looking at what they've shown you, what the profit splits are, if there's a preferred return, if there's a waterfall with various hurdles and thresholds. You should already have that in the marketing materials. Now, it doesn't mean you will, because some sponsors neglect to put that in there. But if they're doing a really good job, you should already have a pretty good idea about that stuff. That portion of the operating agreement is important. Really, what you just need to do is make sure it conforms to the marketing that you were already shown. So I don't really look at that piece of the operating agreement as being the most important part. What I think is the most important is the parts that weren't put in their marketing materials. Things like transfer restrictions. It's important for you to understand what the restrictions are in you transferring out of that membership. Do you have any redemption rights? Can you get out if you need to? Generally, the answer is going to be no. Can you sell your interest to somebody else? Generally, the answer is going to be yes, but it's difficult. The capital call provisions are another gotcha. A capital call provision could be in there that says, if we need more money, we can ask you for more money and you have to give it to us. In other words, let's say you're running a multifamily property and the costs go over and rents come under and the company runs out of money. And of course, nobody wants the property to go into foreclosure. So the sponsor can say to the investors, all right, everybody, cough up another 10 grand so that we can stay solvent. Is there a capital call provision in the operating room that requires you to contribute that additional money? If there is, you need to make sure that you're going to have access to that capital later on down the line. I would say more often than not, if there's a mandatory capital call provision, that might be an investment you'd want to avoid. But nevertheless, you might see those in there, and maybe that's something that you're comfortable with, in which case that's fine. But those are probably the big gotchas. That capital call provision is probably the biggest gotcha. That catches more people by surprise. If they get a letter from the sponsor saying cough up money, that's usually a shocker for most people. And watch for those agreements where you don't see that provision or where the capital call provisions are voluntary. Those would be more desirable, in my opinion.
For sure, yeah. I guess, though, there is some sense of risk reduction with having a mandatory call. I guess you could look at it that way, but at the same time, it isn't something I'd like to see.
Yeah, you don't.
Yeah.
And in terms of risk, what you want to see there is, does the sponsor have other mechanisms to be able to handle a capital shortfall without a required capital call to you? In other words, can the sponsor loan money into the entity? You would certainly want to see that answer as a yes. And not only just can they per the agreement, but can they? Do the sponsors have any money? Are you investing with a sponsor that doesn't have a dime to his name? Because if you are, that could be a big risk factor for you. But if the sponsor has been in the business for a while and is liquid and has resources, that gets a little bit more safety for you, because the sponsor can loan money in to keep the project afloat instead of issuing a capital call to you. That's one thing to think about. Another is, generally speaking, if there's a non-mandatory capital call provision, the sponsor can still issue a capital call and you can have the choice, do I fulfill it or do I not? And let's say you decide not to, then the sponsor would then have the right to raise that capital from someone else. And then that would dilute your position because you would have a smaller piece of the pie as there was more capital relative to the capital you put in. So there should be provisions to allow for risk mitigation and emergency situations without having to have a mandatory capital call provision. So you'd want to look at the totality of that whole thing.
Yeah. Let's talk a little bit about title, how that is held within a syndication, and what does that have to do with a passive investor?
Generally, title is going to be held in the name of the entity. And so if it's a very simple syndication structure where you have one LLC, for example, that's created that owns the property, and you have investors that put money directly into that LLC, title would be held in the name of that LLC. Now, there's a number of circumstances where you're going to see a more complex entity structure where you might have a single member disregarded entity, which could be a second LLC that owns title to the property. And then the entity that you invested in is the sole member of that single member disregarded LLC. And sometimes that's done to satisfy loan requirements. You might also see a multi-tiered structure where you have a joint venture equity partner that's contributed capital. Say, for example, a single check writer that came in and did half of it. They might want to be in by themselves and not be in with other investors, in which case the syndication structure might look like branches of a tree where the property is owned by one LLC, which is owned by two LLCs, the single check writer LLC and the multi-member syndication LLC, and so on. Title can be held in a variety of different ways. And if it gets confusing, you should be able to ask the investment sponsor to show you an organizational chart so you can see a pictorial depiction of what all these various entities look like and how they relate to one another.
Is the risk for the passive investor increased if they are in the entity that is holding title to the property?
In my opinion, no. There could be some lawyers that would argue differently, and I'm not a lawyer. Don't take this as legal advice, but I look at it like an entity provides a certain amount of legal protection. Now, whether you stack an entity behind an individual, or just an entity behind an individual, to me, I don't see a lot of benefit to that in terms of liability protection. If they're going to be able to, quote unquote, pierce a corporate veil, I would imagine that piercing 5 of them or one of them is probably about the same threshold to get over. But you should ask your legal counsel if they feel as though you need to have your interest held in your own LLC, for example. And we've had people that do that. We have investors that form an LLC just to make an investment into one of our syndications. And they do that for each investment they make. They form a separate LLC. I don't understand it at all. To me, it seems like an incredible cost burden with very little benefit, but perhaps they're getting different advice, and that's fine.
Yeah, I suspect that advice is going to vary from attorney to attorney. At least that's been my experience. Anyway, it depends on the attorney you talk to. And I guess depends on your level of risk and how you feel about risk as well.
Enlightened investors will be right back after this important message. I hope you're finding today's show informative and enlightening, and that you will please take a moment to find us on Apple Podcast and leave us a review. Each week for the first 4 weeks of the launch, we will hold a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. Reviews are very important for growing our audience. Your review will be immensely appreciated and will help others find their avenue to financial freedom.
Let's talk a little bit about waterfalls. You had mentioned waterfall a little bit earlier. So first of all, explain what the waterfall is, and then waterfalls can get quite complicated, but let's try to keep it as simplified as we possibly can here. So what is a waterfall?
A waterfall is a method of distributing profits. So if I have $100 to distribute, where is it going to go? Now let's talk about the simplest waterfall there is. When I first started flipping houses, I went to investors and I said, if you'll put up the money, I'll do all of the work and we'll split the profits 50-50. That's the easiest waterfall there is. So whatever, if $100 is to be distributed, $50 goes to the person that did all the work and $50 goes to the person that brought all the money. That's the simplest waterfall. Now, it doesn't work for a lot of situations. It works fine in things like house flipping and that sort of stuff where they're very short term and very labor intensive. But in the case of, let's say, a multifamily apartment building that's going to be held for a period of years, the sponsor is going to do a lot of work up front, and then they're going to manage the property over a period of time, and then they're going to manage the sale at the end. And for them to get 50% of the profits when their investors are putting up millions is probably slanted too far in the sponsor's favor. The reward is too great for the amount of work that's expended. This waterfall structure was created as a way to balance the fairness to the investor with the fairness to the sponsor, and also to incentivize the sponsor to enhance their performance and do the best job possible. And the simplest waterfall is what we call a pref with a one-tier split. And the way this would work is you'd hear of it termed something like this. It's an 8% preferred return and then a 70-30 split where the investors are getting 70% and the sponsor is getting 30%. So an 8% pref and then a 70-30. That's usually the way it's described. And what this means is that 100% of the capital that's distributed will get distributed to the investors until such time that they've earned an 8% return on their money. So if $100 goes out the door, the whole $100 goes to the investor. Now, once the investor has made an 8% return, then after that time and after that time only, if more money is distributed, then the sponsor will get 30% and the investor will get 70%. But before that hurdle has been met, the investor is getting 100%. And so if the investment underperforms, let's say the sponsor doesn't do a good job, or maybe the market just went to crap and the deal just didn't perform. Let's say a deal only threw off 8%. The investors would get all of it. The sponsor would earn nothing, and the investors would get all of it, 100% of it. Now, if you flip that around the other way and you say you guys hit a grand slam, the sponsor is going to be heavily rewarded, because once you hit your 8% return, the sponsor is going to get 30% of all profits after that point. And so they'll be rewarded for their efforts. There's variations on these waterfalls where there's multi-tiers, where after the 70-30, you could hit, say, a 15 and then it becomes a 60-40, or after an 18, it becomes a 50-50. There's a variety of different follow-on hurdles that you'll commonly see placed in these waterfalls, and those can get quite complex.
Yeah, I bet they can. That gives us a good understanding as to how they work and what a passive investor can expect from that. Talk about the 3 primary performance indicators that a passive investor needs to be concerned with.
Yeah, everybody wants to have a way to quantify the performance of their investment. And so there's really 3 ways that I've seen that I've found to be the most important quantitative measurements of return on investment. And that is the internal rate of return is the first one. The second one is the cash on cash return. And the third one is the equity multiple. Going through each of these 3, the IRR, or internal rate of return, is probably the most commonly used. And what IRR means is it's basically boiling down to a percentage return on your money. And it's very easy to understand. You think about it like, I put my money in a savings account and I earned 0.25%. Well, this is the same kind of thing, although you'd certainly hope that in a syndication investment, you're not earning 0.25%. You might be shooting for a 15% IRR or maybe a 12% IRR, depending upon the level of risk that this deal has. But the IRR is just simply a measurement of the return on your investment in a percentage basis. And IRR is useful because it takes into account the timing of distributions and the amount of money that you have in a deal. So in other words, if halfway through the deal, you get half of your money back because of a refinance, now you only have half your money remaining in the deal. IRR will account for all of those things. It'll account for you getting some money back. It'll account for larger payments in the end versus smaller payments up front. It takes all that into account to give you a percentage rate of return. Cash on cash return is just simply a measure of the money that is distributed to you from operations relative to the amount you invested. So if you invested $100,000 and you got a check every year for $8,000, you would be getting an 8% cash on cash return. Simple as that. Equity multiple is, if you think about going to Vegas and putting all your money on black, if it hits, you double your money. That's an equity multiple. If you put your money in a syndication investment, you put $100,000 in and you get $200,000 back, that's a 2.0 equity multiple. So if you're looking to double your money, that's the one you want to look at. Now, the thing about equity multiple is it tells a weird story because it doesn't take into account any function of timing whatsoever. So if you put $100,000 in and you get a 2.0 equity multiple in one day, that's going to be an incredible rate of return in the thousands of percent on an annualized basis. But if you put $100,000 in, you get $200,000 back 20 years later, it's the same 2.0 equity multiple, but your return on investment is far lower than if it happened in one day. Equity multiple has to be taken in context, where you compare equity multiples from one investment to another over similar periods of time.
One last thing here before we tie this up, and that is the big payoff day when the capital is returned. How does that occur, and what all is involved in that?
It's a good day, let's say that much, because that means that you had a successful investment, you got your capital back, and hopefully not only did you get your capital back, hopefully you're getting more than your capital back, assuming everything went according to plan. But generally the way you'll see this happen is there's two ways you get capital. Well, there's three ways you get capital back. The first way is just simply from cash flow. If the investment puts out so much cash that you get a return on your capital and your capital back, that would be incredible and also extraordinarily rare. So that would be one way. Another way is through a refinance. So let's say you own a property for you as a group have owned the property for 3 years. The sponsor wants to keep it another 2 years. They refinance the property and they get a cash out refinance. And let's say they're able to return half the equity. You might get a check or a wire or an ACH, depending upon how your sponsor handles distributions, for half of your equity back. That could happen. And then the third way, which is by far the most common way, is the property sells. Most people ask all the time, like, why don't syndication investments, why don't you ever see them last in perpetuity? Or why don't you ever see them for 20 years? They're always 3 to 5 years. And the answer is that any sponsor that's raising money from other people, the first question those other people will always ask is, when do I get my money back? And so really the only way you get your money back is through a sale. Everybody wants to see their cash again. Nobody wants to lock it up in perpetuity. At least most people don't. So generally speaking, in 3 to 5 years, or maybe 7 to 10 years, depending upon the life cycle of the investment, the property will sell and the sponsor will send you your capital back plus whatever return you got from the sale. And they'll run the distribution through the waterfall calculations. They'll determine how much you're supposed to get and how much they're supposed to get. And then they send out a report, or they should be sending out a report about the income and the performance of the investment along with your distribution. And then that's usually pretty much it. We tend to hold back a fairly substantial amount of money in a bank account in case there's things that come up, and there always are after the sale. And then once we're comfortable that all of those expenses have been fully paid, then we make usually 2 to 3 follow-on distributions as we shrink the amount of that reserve capital down to zero over time. So you might see some checks that come in a month later, a quarter later, and even a year later. And then it's done. That's the end of the investment. You'll get a final K-1 for your final tax reporting purposes, and that's it. It's time to reinvest and make money on the next deal.
I was actually talking to a syndicator just the day before yesterday this was really a home run deal. They had returned 100% of the capital from cash flow within 3 years of the purchase of the property. That doesn't happen very often, but they were able to do that. So it does happen.
Yeah,
but,
it's extraordinarily rare, but it happens.
Very, very rare. Brian, is there anything else that we really need to touch on? What a passive investor needs to know?
Yeah, I think that perhaps the most important thing that a passive investor needs to know, and that is that there's an age-old question of what's more important, the deal or the sponsor you're investing with. And the debate rages on, but I'll render my opinion. The sponsor, the person that you're investing with, the one putting together the deal, the one doing all the work, the one responsible for all of this stuff, is equally important and arguably far more important than the deal that you're investing in. When you're out seeking passive investment opportunities, the first thing that you should do is you should look for competent sponsors to invest with. You should do a full and complete due diligence on that sponsor's company and on their group and on them as individuals. Make sure that you're fully comfortable with their qualifications and, most importantly, their character before making a decision to invest with them. And then once you've done that, you can put together your list of investor sponsors that you like, and you just sit back and you wait for them to show you the right deal. And when they show you the right deal, you invest in it. But always look at the people first and the deal second. I think that's the most important thing that people can learn. And it's also the biggest mistake people make is they don't do that.
The stimulus for actually writing your book, as I mentioned earlier, was that you had a friend who apparently didn't do that. Can you share their story with us and what happened with all of that?
Yeah, this is a story of someone that I worked with as a teenager. When I worked in the grocery store, my first job I was a grocery bagger, and there was a checker that worked in the store that had bought a couple of fourplexes somehow by saving up paychecks and made these 2 real estate investments, sold them a number of years, maybe a couple of decades later, and had a really nice payday. Invested all of the proceeds in a real estate syndication with a sponsor that later turned out to be a crook. Stole all the money and lost the properties in foreclosure, and all the investors were 100% wiped out. For her, this represented almost all of her life savings. And she went from being set for life to driving for a rideshare to put food on the table. And it just underscores the seriousness of making these investment decisions, not jumping into anything you don't understand, and making sure that you're investing with the right people and doing that due diligence to invest with the right sponsors so the same thing doesn't happen to you. I felt like writing The Hands-Off Investor would be an outlet for me to be able to show people a roadmap for how to think about these investments in a thoughtful way. And if I could prevent that experience that happened to my friend from happening to anyone else, even if it's only one person, then I think writing this book will have been 100% worth it.
Heartbreaking story. A whole lifetime of work shot down within just a few short years. Well, Brian, tell us how we can get in touch with you and how we can get hold of a copy of your book.
You can find me through our company website. Our company is Praxis Capital. Our site is praxcap.com. It's praxcap.com. You can also find me on Instagram at Investor Brian Burke. You can find me on biggerpockets.com answering questions in the question and answer forums. Lots of ways to find me. To find the book, there's really 2 ways to find it. There's 3. Amazon is a popular way, of course. The Hands-Off Investor is available on Amazon. It's also available on biggerpockets.com/syndication book. And if you buy it from there, they're the publisher. And if you buy it from them, you get some bonus content, which is cool. Questions, like 75 questions to ask a sponsor is one of them. There's a couple of video interviews with a couple of passive investors as a bonus chapter. So some cool bonus content that you get ordering direct from the publisher. And the third way is to visit a bookstore if you can find one that's still open and pick it up there if they have it.
Brian, for my last question today, share with us one of the most difficult setbacks you've had in life, and how did you deal with that? How did you come through it, and what did you learn from the experience?
2009 was my most difficult setback. Remember the great financial collapse, Alan, when it seemed like the world was coming to
it? It did. Yeah. It did come to the end for me. Yeah.
Yeah, it did for me too. It was a really painful experience. And I had a lot of projects out there with investor money. And I was very fortunate that all of those did well enough because we were investing in distressed real estate that I didn't lose any investor money. And knock on wood, in 23 years of raising money from private investors, I've never lost a nickel of their principal, and I hope to keep that record going. So I survived it from that aspect, but I was an entrepreneur, and as entrepreneurs, we like to expand our horizons and try new things. So I took everything I could cobble together and invested in all sorts of oddball real estate projects to see if I was any good at it before raising investors' money to do it, and found out either I wasn't that good at all those other oddball things, or the market sure didn't do me any favors, and dang near wiped me out from that experience. And so I was faced with a challenge of how do I recover from this? And I really had 2 choices. I could shrink my way out of it, which in other words, go crawl in a hole, get a job again and start earning a paycheck. And hopefully one day I could earn enough money to get back to where I was, which wouldn't have happened in a lifetime, by the way. I could grow my way out of it, which means grow the business so big that I can make that look like just a small setback in history. Those are really my two choices, and you can see which one I chose. I chose to grow my way out of it, and it worked remarkably well. In terms of what did I learn from it, the biggest lesson was not to stray outside of my box, just stay in my own lane, do what I know I'm good at, learn to say no to all these opportunities that sound so enticing to get into, and instead just stay right down the middle of the fairway and do what I'm good at, and I'll be just fine. And so ever since then, I've pretty much stayed right down the middle of the fairway, and that has treated me really well.
Well, Brian, it's been a very enlightening conversation, and once again, a pleasure being back with you. So thanks for being on the show today.
Thanks for having me on again, Alan.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steed Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid passive real estate investments. As part of our efforts to make the world a better place, Steed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at steedtalker.com.